it's going to cause people to rotate into the precious metals. I think we're in a 50-year bull market in gold and silver. Gold's already broken out, 50-year breakout. Silver hasn't done the 50-year breakout. It traditionally comes after gold. And as we continue to have additional servicing costs for all this debt around the world, and we continue to have the whole world trying to sell their bonds at one time, it's going to collapse the bond markets, and that's going to take down economies, and it's going to shoot the price of gold and silver up. Everybody, this is Rob Kientz with the Freedom Report. We are back to do a deep dive on gold. We're going to show you everything that's happening in the gold markets, the ins and the outs. But first, we're going to tell you about the ticking global debt time bomb that's about to go off, and it's going to affect all of the markets, governments, and the prices of gold and silver. And for gold and silver stackers, it couldn't happen at a better time, because gold has already broken out, silver has broken out, and we're sitting on very bullish technical signals for both. But before we get into that, let's talk about the debt markets, and we're going to roll right into the share. Those that have viewed me before know that I like to share data. I'm a data head, and so we're going to talk about the data, and we're going to talk about what that data means and why it's important to you and why you need to pay attention to it. So we're going to start with historical debt outstanding. So as you can see here, we're looking at fiscal data at treasury.gov, and that is where we get our debt data. We're going to start here by looking at a custom view of debt. Now I'm going to start from the beginning of 1970 and go through the latest that they have the data for, which was September 30th of 2024. This would be pretty close to the overall total debt numbers, which is now over $37 trillion. The reason I'm using the 1970 start date is because that was the year before the United States brought the dollar off of the gold standard. And you're going to notice something about that. When Nixon took the United States off the gold standard and we went to a pure fiat-based economy, meaning we just traded dollars and they weren't tied to a commodity like gold, you're going to notice something very interesting in the debt market. So here you can see the table. In 1970, when that was done, get it right there, we had $398 billion of debt. Now we have well over 37 trillion. According to this, in 2024, it's 35.46. So we've added about 2 trillion in about a year of debt. And the rate of acceleration, not only the amount of total debt, but the rate of acceleration, how much we're adding each year, keeps going up. Well, why is that? Well, because as inflation in prices pushes the cost of everything up in an economy, you have to take on more debt to service normal government functions. And not only do you have to take on normal debt to service normal government functions, so it accelerates the amount of debt that you have to issue. In addition, we're issuing more debt because we're spending more proportionally than we have in the past. In other words, government spending is outpacing the general rate of inflation in the economy. So for those two reasons, inflation is rising, which is causing the value of the dollar to go down, which means you need to take on more debt to get the same effect in the economy. We're also spending more as a percentage than we used to. And that's why this debt has completely blown up. Well, okay, fine, Rob, we have $37 trillion in debt. Hey, we can just print dollars. We owe it to ourselves. What's the problem? Well, it doesn't quite work that way. And let's talk about why. On the next chart, though, I wanted to break down really where we're issuing the debt. This will be important when it comes to figuring out how much money we're going to need to pay it back. So when you buy a government bond, you can buy it in short, medium, or long term. You can buy it in short-term T-bills, medium term, 2 to 10 year maturity, 10 year being the benchmark, or you can buy it longer term, 20 or 30 years. And you can also do treasury inflation protected securities. So at the bottom, we're not going to focus on that. But if you look at where the increase in debt is coming over the last few years, certainly since 2020 and more towards 2015, we were issuing more debt in the short to medium term, not the long term. And what that means is to recycle that debt. In other words, you have to reissue new bonds when these expire to pay the old ones off, because we're not paying that debt off with cash because the government doesn't have a lot of free cash. You're rolling that debt over into a new interest rate. And now, as long as interest rates are falling, you can pretty much do this forever. In fact, as interest rates are falling, it allows you to refinance your debt over time and actually pay less debt service. The problem is we'll see in the next few charts, is interest rates aren't exactly falling. In fact, we have a nice chart here from the Federal Reserve's database from the St. Louis Fed, which tracks this. And you can see that the overall amount of interest rate on U.S. Treasuries was at its highest in 1981. That was when we had that high inflation from the late 70s to the early 80s. Volcker, who was the Fed chairman at that time, raised interest rates up to 18, almost 19%. And that caused the amount of money issuance and lending to come down, and it slowed the economy down. We could do that back then because overall amounts of debt weren't high. So you could shoot that interest rate up really high in the short term, and it wasn't going to break the system. The problem is we've had falling interest rates since that time for about 40 something years, almost 44, 45 years. It just went down, 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 down. The problem is after the last recession, the Great Recession in 2009, 2010, 2008 through part of 2010, interest rates have started to rise again, and they're rising into a market of increasing debt. So what does that mean? Well, it just means that we're increasing our debt and not paying it off. We don't have the cash to do that. And we're issuing more debt. Remember, for the two reasons I said at the beginning of the video, we have to issue more to cover inflation, and we have to issue more to cover increased spending proportionally to what we spent before. Both factors are accelerating the amount of debt that we issue every year. Again, that worked as long as interest rates were falling, which it did from 1981 to right there, the inflection point, 2020. What was going on in 2020? You had the pandemic. You had COVID. And that spiked an increase in rates because we shut down our economies. We shut down our economies, for the health scare, all of that. We rebooted the economies. They're not fully rebuilt back out again. So that increased risks. Okay. It also reduced lending. So the interest rates had to go up for the economy to deal with the reduced lending in the economy. And what that's done is we've now had 5 years of basically rising interest rates overall on the 10-year Treasury securities. And now it hasn't risen to the point of breaking the system, but many analysts think that once the 10-year Treasury sits at 5% and higher, that we're not going to be able to service that debt, and the risk of default goes up. And you have two options. You can either default on the debt because you can't pay it because the interest rate costs are too high. You just default and it ruins your national credit rating. It would crash the dollar. There would be very substantial economic consequences that lead us into a Great Depression. The government doesn't want to do that. Doesn't want to completely ruin its credit rating and the strength of the dollar, because then the whole economy implodes, and that includes government as well. So the governments are going to be interested in the second option, which is print money, print money, print money. You know from all of my videos in the past 5-6 years that we've just printed more and more and more. So what they're going to do is inflate away the debt. Well, what happens when you print money faster than you increase national production of products and services? Inflation, prices go up. You have more dollars bidding on goods which aren't rising as fast, and that raises prices. And that's exactly what we're seeing. So if we roll on over here, there's a really nice report put out by the Peter G. Peterson Foundation on what's going on with interest payments. Well, let's talk about how much the government has to pay to finance all these treasuries and all this national debt. And is that going up? Is there a breaking point? What's going on there? So looking at this, it says interest payments in fiscal year 25. The cumulative interest costs this year are higher than in recent years. In fact, I'm going to blow this up a little bit for you guys. And you can see here's fiscal year 25. And our cumulative costs right now are $665 billion. In 24, they were, cumulative for the year, they were less. So let's go over that. Cumulative fiscal year 25 interest payment, 665. Fiscal year 2024, 601. Okay, so it went up 24 billion. Well, simply issue 24 billion in new securities and you got that paid for, right? Well, what happens when that goes over and over and over again, and the cost to reissue debt to pay off, those interest rates is rising at the same time? Well, what happens is interest rate becomes the third largest spending category to date for the federal government. So Social Security is highest at over $1 trillion for the fiscal year. Medicaid is $700 billion. Interest rate debt to pay off this debt or service this debt, sorry, not pay it off, but service it for the people that are holding that debt is almost as much as Medicare, and it's higher than our national defense. We're paying more to service a debt we've already issued for things that we've already used up than we are for our national defense. And pretty soon, by next year, most likely, interest rate costs will be higher than Medicare, most likely. And it'll be the second. And it won't be too long before interest rate expense eventually eclipses the cost for Social Security. It will be the highest. And when that happens, ladies and gentlemen, I'm telling you, the national economy is in deep, deep trouble. And according to the Congressional Budget Office, we have that chart which explains it. Interest payments over the next 10 years. The nation's rising debt and relatively high interest rates will continue to put upward pressure on federal borrowing costs. Interest payments are projected to be the fastest growing portion of the federal budget in the upcoming years, as you can see on the chart. The Congressional Budget Office, or CBO, projects that if current laws generally remain the same, net interest payments will total $13.8 trillion over the next decade, rising from an annual cost of $1 trillion in 2026 to $1.8 trillion in 2035. So in 2026, the debt service cost, according to the Congressional Budget Office, will roughly equal what we pay in Social Security. Like I said, it's not going to take that long before interest rate debt next year probably eclipses everything else we spend in government. Now, when the interest rate debt for what we've already spent goes up that high, we have to what? We either have to print more money to pay for it and cause more inflation to make that system work, issue more debt to pay for it, or simply cut services. So what has the current administration done to try to address this? They had Doge and these other programs to try to address it and cut costs. They wanted to cut $2 trillion. Why they want to cut $2 trillion? Because that effectively would nullify the recent increases in the national interest payments, which have been rising. The problem is they only got to about 150 billion. And there have been comments coming out from the Doge technical team that it's not that the government is inefficient with the money. It's more that they're just spending so much on so many things that you have to cut spending. You're not going to be able to make it more efficient and recover that $1 to $2 trillion, which they originally thought. What that taught them was you could get 150 billion out of it by becoming more efficient and cutting all these things. But really what you have to do to get it down is simply stop spending money. Well, if we stop spending money, what happens? You don't have enough money to pay Social Security outlays. You don't have enough money to pay for promised Medicare outlays. You have to cut national defense. You have to cut these other programs. Which one's going to go first? Is the government going to do it? Maybe, probably not, because they never have in history. And if they try, they'd probably lose their seats. Congress would lose their seats. You'd have definitely a new presidential administration. You would have massive changes. You would have a revolt of the people. But let's look here at some detail about what the Congressional Budget Office and the Peter G. Peterson Foundation have found in this study. It says, in fact, by pretty much any measurement, interest on the national debt will soon exceed the highest levels recorded in the post-World War II period. That's 80 years. In dollar terms, interest costs reach an all-time high of $476 billion in 2022 and have risen rapidly since then. CBO projects that such costs will total $952 billion in 2025 and over $1 trillion in 2026. Relative to the size of the economy, interest costs would reach 3.2% of gross domestic product in 2026, eclipsing the previous high set in 1991. Interest costs would climb to 4.1% of GDP by 2035 under the CBO's projections. That's insanity. We simply cannot afford that. We can't. As a share of federal revenues, federal interest payments would rise to 18.4% by the end of 2025, exceeding the previous high set in 1971. They would reach 22.2% by 2035 as a share of revenues. You're going to have a fifth of all expenditures going to interest rate debt in about 10 years, and 18.4% this year, almost 20%. As a percentage of total spending, interest costs would reach 15.6% by 2031, surpassing the previous high of 15.4% in 1996. Okay, so what, Rob? We'll deal with that. We'll print money. We'll do all this stuff. U.S. is isolated in this environment. Nothing can affect it, right? Well, not exactly. The Bank of Japan is reversing a trend over the last several decades in shrinking their bond holdings. Well, why does that matter? Well, the Bank of Japan, as a percentage of its national income and per person, per capita, is the country that probably has more debt or issued more debt as a national than any other country over probably the last 23 years, any other substantial world economy. And that worked because all the rest of the world was buying their debt. What happened was the carry trade in Japan unwound recently, meaning people would buy Japanese bonds which had almost a 0% interest rate. And then they would carry that into other trades. Well, once interest rates started going up in Japan, that carry trade unwound. When that carry trade unwound, it started to affect global markets. And it started to affect the ability of Japan to service its debt. First of all, it didn't have enough income to service debt, much like the U.S. is heading into, but the rest of the world wasn't buying their debt either. And as that carry trade unwound, people weren't demanding Japanese bonds because they weren't making money on the difference between the Japanese bond rate and other available liquid investments. So the rising Japanese bond interest rates have, one, stopped people from buying their bonds, and two, raised the cost that they have to service the existing ones. That's a double whammy, and it's going to be a collapse eventually of the Japanese economy. So what Japanese are trying to do are issue or sell bonds now into the global market, get rid of them at a time when nobody wants to buy them. What does that mean? It means less dollars for what? The US bond market, the Chinese bond market, European bond market, any of the bond markets. This threatens to cause a global debt collapse. And that's what we're seeing right now. Debt is so high across the world that studies have shown we cannot recover. There must be some sort of collapse, or there be a deflationary collapse or hyperinflation by printing world currencies too much. And that's exactly what we're headed into. And why does that matter? Well, gold prices are up now very, very high, about 3,400 range trading. We'll show you the price in a minute. Gold price has doubled in about the last 18 months, give or take. And the reason for that is because the bond markets are basically informing us of what's about to happen with world economies. And what happens when the traditional safety investment of the last 40, 50 years, bonds, start to come under trouble? Well, you go to the historically most important safety asset, the ultimate safety asset in the system, and that would be gold. So as the bond market's been having problems and it starts to implode and it works its way from Japan around to the rest of the world, in a rising interest rate environment and less money for investors to buy these bonds, and the thing collapses, the bond market Ponzi system worldwide collapses, not just in Japan, but it spreads to the rest of the world, gold is going to continue to shoot up. This is very bullish for gold in the long term. All right, now on to gold. We want to talk first about the CME Group's website. This is the trading, the COMEX data here in the United States, and we're just going to take a look at it and kind of explain what this means. So up here is volume. That's how much how many trades there are, right? Volume is completed trades as a percentage of the overall open interest. Open interest is the total positions on the COMEX, and the volume is how many trades did you have. When you see increasing volume in gold, that typically means there's a lot of short pressure in there and it's lowering the cost, okay? And so we had in May some fade, and we had some rise and some fade. That's generally kind of how you look at gold. Generally, when there's a lot of trades, a lot of shorts coming in, they're trying to take advantage of some short covering and take advantage of short-term price movements. Right now, we have about medium trade in gold, and it's doing okay. And we see some rotation. We see contracts coming out of the June contract, and they're really rotating into August. So August is really the month at which we're looking at the most trade. So that's really what affects the prices the most. And you can simply look at the open interest as being the highest in August than any other by that column that I've highlighted. There are currently, as of today's reporting, 332,177 contracts of 100-ounce gold. That means every contract has 100 ounces in it. So you add 2 zeros to that to get about 33 million ounces of gold in open interest right now. That gives you a clue about the size of that contract trading month. Well, why is all the trading done in August if we're in June, Rob? That's 2 months away. That doesn't make sense because the COMEX is a futures market. It is a bet on a piece of paper, really a computer system, but it's not in real gold and silver. This is not indicative of the physical trade. The physical trade is a little bitty part. And how do we know that? Because of deliveries. There were 708 deliveries, okay, on today's data, but the settlements were actually much higher. So we're going to load the settlements chart. And if you look at settlements, our volume on the August trade, we had 193,000 contracts. 193,000 contracts is all the paper that was trading, but the physical deliveries were only 708. That's not even close to 0.1%. So the gold prices in the United States are not determined at your local coin dealer. They're not determined by physical trade unless we have a trade breakout. 99.999% of the time around the world, United States, and even into, the London markets and the rest of the world, except for China and Dubai, which are heavily physically traded. But in the West, most of the trade is paper. It's betting. It's a casino. And you don't have to have all the gold to back this up unless somebody calls you for delivery. And even though there have been high deliveries lately, they can also cash settle. So there's no guarantee that high prices in this market leads to basically delivery of all that gold. So that allows the price to move around a lot. Okay, it allows the price to move around a lot. And it can also lead to manipulation of that price. If somebody wants it to go higher or lower, they can simply put a bunch of contracts on. Now, they can get in trouble doing that, but when you have a lot of money and a lot of liquidity, you can do that. You can push that price around, and if you're dealing with thousands of contracts, you don't have to move that price just a little bit to make a bunch of money. So that's basically how that market works. So that's gold. And we're going to take a look at the gold trading chart. Now, those who have been watching my channel for a long time have seen me put this up. And what I like to do is do some technical analysis, right? And in gold, I basically charted out some trading indicators. At the bottom, you can see I have the RSI, which is relative strength indicator. When that hits about 70%, you can say that the market is too hot and it needs to come down, okay? And when it goes below 30%, you can say there's nobody trading this. Price needs to go up or volume needs to go up, right? Well, as we can see right now, the RSI is at 71.25. So even that gold is trading at 33.22 and 12 cents at the moment. It's basically telling us the price can go high because relative to what happened over the last 6 months, couple of years, the strength of the market is not super high. It's kind of faded a little bit. And you can see that here. Basically, we had one of the largest breakouts in history dating back to February of last year. So about over the last year and 4 to 5 months, we've had the largest price breakout as a percentage of the price in the history of U.S. trading, really. Because think about it, before gold was pegged to a certain amount of gold per dollar, then in 71, it traded freely. And so basically in the last 50 years, this is the biggest breakout. So we've had a 50-year breakout in the gold price. And these colored areas over here, these tranches, if you will, these little boxes on the right is a Fibonacci. What a Fibonacci is a famous Italian mathematician that figured out things in life, whether it be markets or nature or other things, tend to move in patterns. And Fibonacci is a way in which you can sort of measure that pattern. In other words, it's like looking at levels. So we've got the Fibonacci graphed out on this gold chart, and you can see that we're at the top Fibonacci. In other words, we've had a breakout. This is the top Fibonacci. If I break this out to a longer term trading chart, you can see the Fibonaccis that are basically plotted over here. And gold broke out into the last of these major trading ranges in April of 2024. And it has run the hardest it's ever run in history. From April 2024 to now, you've had this kind of spike. That kind of spike before took from 2008 to 2011. So we've basically had from 2008 to 2011, you have the same amount of movement that we've had over the last 14, 15, 16 months. Okay, that's a compression of a 3-year breakout. Last time we had a recession that took less than half of that amount of time, and technically we're not even in a recession. Okay, what is that gold price movement, that doubling of the last previous biggest market, that doubling in the last year and a half telling you about the global markets? Why? Because gold is a safe haven asset. People go to gold when they have issues. Are we having issues? Yes, because the Bank of Japan is cratering, their bond market is cratering, and we're having major issues because we've issued too much and we're not going to be able to pay it off. And the global bond markets are in trouble, and that's what gold is reflecting. People know this time when we get to the next recession, people are not going to go to bonds. The bond market is already crashing. It's already a major issue. They're going to go to gold. Gold is the ultimate safe haven asset. In addition, gold has been made a high quality liquid asset in HQLA and Basel III and Basel IV requirements. And so central banks are buying a bunch of it. And as a matter of fact, we have a Bloomberg article up, and this is a paywall article, but just read the title. More central banks than ever plan to build up their gold hoards. Is it any wonder why the Bank of Japan and other people are dumping bonds and buying gold? There is a capital rotation out of bond market into the gold market worldwide that is starting very quietly, and that's going to absolutely explode the gold market. So we're going to continue to see a breakout. This 50-year breakout is not done. It's pausing, it's resting over the last few weeks to a month, but it's not done. And typically in the summer, gold will fade a bit. A lot of the financial markets kind of soften a bit as people go on vacation and things. And about August, gold starts to get really frothy. So we're going to come back in August and we're going to look at the dynamics of the gold market and see what's happening as people get back into finance. Because either they're going to get back into bonds and stocks and real estate, or they're going to get back into gold. And that'll give us an idea of what happens for the rest of the year. So we'll come back to that again. In fact, we'll do that more. We'll do it more often. But specifically, we're going to look in August, about mid-August, and see what's going on as people come back to these markets. Are they moving dollars out of bonds, stocks, and real estate into gold? What are they doing? Bitcoin, cryptos? We'll look at all of that. Now it gives a good idea of where gold may be projected to go to the end of the year. If you're looking at some of the major banks like Goldman Sachs and Bank of America, they're seeing much higher gold price targets because they're seeing the same thing I'm seeing. But we'll see what happens when it happens. All right, on to silver. This is the silver data. You see higher volume in silver relative to, say, the past, couple of months. People are more interested in silver. Silver price has gone up. Silver's gotten into a little bit of a breakout, and you're seeing that here on the COMEX markets. And as you can see, we've got a roll off from the July contract, and the new dominant contract in silver is September. Remember, this is a futures trade, so they're betting on the price from now to September. It's a game and casino market. We had 64 deliveries, but if we look at settlements, on that September contract, 41,000 settlements. So 41,000 settlements volume for the day's data. However, delivery sat at, it's refreshing the screen. Delivery sat at 64. It's right here. Not even a tenth, probably not even 1/100% was settled in physical trade. Again, this is a paper market on computer. We call it paper market. It's done by computer. And it's not actual physical trading hands. Much more of this paper is trading hands of physical, so that allows that price to really move around a lot. And that tells you that despite the fact that retail in the United States is still a little slow in buying silver, other people are, but what's affecting that price is people coming from the bond markets, coming from the other markets, coming into COMEX and bidding that price up. And again, we'll come back in August and see if that trend continues. But so far, for the last 15 to 16 months, gold has run, and over about the last month-ish, silver has started to break out, and we'll look at the silver chart. So as we look at silver, we really got, on the Fibonacci's back the beginning of June. We basically broke into this new range. Again, Fibonacci's are just levels. They're mathematical levels observed in nature, in markets, and in other things that give us an idea of where we are relative to the past. Okay, it's a way to look at the market and say, whoa, that's a big breakout. It's not really doing much, or man, that thing is cratering. And you can see that silver broke out past the 618 Fibonacci number into this zone. Okay, that's a major breakout. And we're going to show you here in a minute why. I'm going to show you a chart from North Star bad charts. But we basically have a cup and handle pattern. So a couple of indicators here. First, the RSI, that's the easy one, relative strength indicator, is sitting down at 62.91. That's well under the 70. So even though silver has broken out recently this month, okay, which by the way goes against the summer pattern for silver, it's breaking out into a weak seasonal month. First of all, that's your indication silver wants to run. It's reduced volume, higher prices. Typically, people don't buy as much in June. Why is it running? Because gold's already had its breakout. Now people are going to silver. That's what happens. Silver follows gold on the breakout. And so, but it's still got more room to run because that RSI is not at 70 yet. It's not considered overbought, right? And also, if you look at a long-term silver chart, if you go back to like the early 70s, you've got this rising wedge pattern. You've got higher highs and higher lows, or a flag pattern if you want. Why? Because the high line is going up more than the low line. In addition, if you look at a long-term chart, this is considered a cup and handle. It's basically a 50-year cup and handle pattern. You've got the cup, you've got the handle, and then it crashed. The lowest price was in April 2020. You had the pandemic, and then you started to have the breakout. A cup and handle pattern, when it occurs in markets, whether it be the metals markets, the stock markets, or just about any market, is well documented. And when you have a cup and handle pattern, cup, handle, so you have a nice market, it craters, it comes back, it goes down a little bit then, but it doesn't go down as a percentage all the way, just a little bit. Usually that means you're going to have a breakout. That is a very bullish indicator. So is this rising wedge or open flag pattern to the upside, higher highs and higher lows. The overall market is moving up, and you have a 50-year technical breakout pattern. And that's why we started to see the breakout in June. We finally started to see those patterns manifest in the silver market to higher prices. And if you look at this chart, once you get to a certain point, actually that show the North Star bad charts that you can see on Kinesis. They have a show on Kinesis Live from the Vault. You can see this silver cup and handle dating back to the early 70s. Cup, handle, breakout. And they're saying that once silver gets past $34, which it has, that it's going to run. And in fact, at about $37 is the last point of resistance until you get to 50. Why 50? That's the highest price ever of silver that happened twice, in the 80s and in 2011. 2011 barely touched on 50. Really, technically, it's 49 something, but essentially 50. And in the early 80s, it was 50. So we're about to hit the highest price ever in silver. Say, well, Rob, isn't that a bearish indicator? Well, if you're about to hit the highest price ever in silver, it's got to go down. No, that's not inflation adjusted. If you inflation adjust it, silver should be sitting at $250. Why? Because dollars are worth less now than they were before. So we're not even at the fifth of the price that we were in 1980 when talked about in real terms, inflation adjusted terms. So we could go much higher. We could go to 250, and then we would be at the level that we were at in the 80s when inflation is taken into account. So this market could massively move up. And once we get to 37 in silver, there is very little, if any, historical resistance to that price from a technical perspective, meaning it could go anywhere. We don't even know where it could go. We don't have the data for it. We just know it could keep running. So what we do then is we turn to the fundamentals of the market and say, are the markets calm now? Are the economies good? Or do we have problems? Okay, and that's just from a monetary perspective. That's not talking about silver shortages where we need it for industry. And if we have a shortage, boom, that price could go up. So silver is a little bit different than gold. It's used more industrially, and that industrial demand has been very high. We haven't been mining enough the last few years, and that's going to cause the silver price to spike as well. Just genuine physical shortages. If we go and look at delivery notices, I like to look at delivery notices to see a percentage of the metals are being delivered, not just to the daily COMEX trade, but also relative to the past. In other words, are people demanding more metal this year than they did last year, the year before? And as we look at the delivery notices on the COMEX, you can see all these numbers are consistently high. Typically, in the COMEX for gold and silver and a lot of the metals, certainly the precious metals, you have about 6 big delivery months. Why? It's a paper market, and you can take delivery, but usually only about 6 months of the year do you see any really established trading volume. Why? It's a futures market. Most people don't take a futures contract for only 30 days. They'll take it for at least 2 months. That's why you'll have a big delivery month, a slower delivery month, a big delivery month, a slower delivery month. That's not really what we have here. In January of this year on the COMEX gold futures, we had almost as many deliveries as we had in December. Now, December is usually one of the biggest delivery months of the year for both gold and silver. It's the end of the year. It's when a lot of people take it before, but we had almost as many deliveries in January as we had the previous December. So that started the year strong, and January is usually not that strong of a month. Well, if you look at February, we spiked to 75,000 contracts of gold. Sorry, I'm talking about gold here. Then in March, 19,000, then in April, 64. Then in May, 25, and then in June, 29. So we're not seeing that on and off pattern in the month. We're seeing every month being a heavy delivery month. Everybody wants the gold. Why do they want the gold? Bond markets are collapsing, gold price goes up. Now, we're having all these deliveries on gold when gold's price has doubled over the last 15, 16, 17 months. That's astounding. Gold is so much more expensive, and yet people are demanding more and more and more of the physical. And these are the big players. The COMEX market is an industrial market. It's not the guys at your store. Certainly the retailers could be buying it and printing out coins and bars. But these are the big players, and we think that they're taking it to offset global systemic risk. Big players have come in. Retail really has not come in very heavy just yet. So these numbers could triple, quadruple, and more when the American public comes into it, or the rest of retail across the world. Now, if we look at silver, it's not as robust. It's not really anything to write home about. Silver physical deliveries are up, but they're not super up. You can see in December of last year, 9,100 contracts. March and May, we had 16 and 15,000 contracts of 5,000 ounce silver delivered. However, silver hasn't really broken out in deliveries just yet. These are pretty decent numbers. I've seen higher. So certainly silver hasn't quite broken out in deliveries just yet, but with the rising price and demand, I expect that to happen pretty closely. And of course, it just broke it out into the months. We just breakout June and look at gold, you can see that on the first contract delivery day, 15,000 contracts of 100 ounce gold. And then it ended up so far at about 29,000. So it's doubled that first day's number. Pretty good number. And that's kind of how that works. All right. Now, what is the outlook for gold? Well, if you look at this chart, gold leads all major assets in 2025. Gold's beating Bitcoin, emerging markets, Swiss franc, yen, all that kind of stuff, according to Financial Times up to June 12th. So as of June 12th, gold was basically beating the snot out of the rest of the markets in terms of performance. So gold is on a run. Doesn't look to be stopping anytime soon. And certainly a lot of the big banks expect that to continue. And what is that again? It's capital rotation. What does Northstar talk about all the time in their videos and in their Twitter? Capital rotation. When money comes out of those other markets, it's going to flood into gold and silver. We're already seeing that in 2025. We've hit an inflection point that gold has now become much more important than the rest of the markets. Now, if it stays that way, that means we're probably heading for several market collapses, stocks, bonds, so on and so forth. Here's a video where Paul Tudor Jones, a billionaire investor, is talking about the outlook for gold on CNBC. I'm going to go ahead and play that. And he has some very, very interesting things to say.
Are you all buying gold and Bitcoin? And
all roads lead to inflation. We're going to end up,
but if all roads lead to inflation, therefore gold is a good investment, Bitcoin a good investment here?
I'm long gold, I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. Probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out and you have a small tax on the consumer and you run interest rates and nominal growth rate. Interest rates below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. So you're going to have the Fed, they should be easy. They should be easy.
You want them to cut?
Just real quickly. Every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax and a scissory. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debt.
There you go. Straight from Paul Tudor Jones. We are going to inflate our way out of the debt, ladies and gentlemen, and that's going to be the playbook. And what is that going to do? It's going to cause people to rotate into the precious metals. I think we're in a 50-year bull market in gold and silver. Gold's already broken out, 50-year breakout. Silver hasn't done the 50-year breakout. It traditionally comes after gold. And as we continue to have additional servicing costs for all this debt around the world, and we continue to have the whole world trying to sell their bonds at one time, it's going to collapse the bond markets, and that's going to take down economies, and it's going to shoot the price of gold and silver up. As you saw Paul Tudor Jones mention, no civilization in history, when we've gotten to this level, has ever done anything else other than try to inflate it away. And for consumers, what that means is everything that you earn is going to buy you less. And he's also talking about them doing a consumer tax. So they're going to raise your taxes. So they're going to take more of your money's worth less, you can buy less. And the only way to offset that is an asset that's doing better, that eclipses the amount of inflation that you're seeing. And the assets, the next 5, 6, 7, probably 8, 9, 10 years that are going to help you make up for all the losses of inflation and additional taxes that are coming, that you saw that billionaire tell you that has been world history, okay, is to buy gold and silver. That's the answer to the problem. And I wanted to show you how you can do that. So we're going to roll over here to my Kinesis account. We're going to take a look at how do you trade? So I'm logged into Kinesis, and certainly I use Kinesis to do a lot of my gold trades. And here we're seeing a chart of KEU, which is basically their gold unit. I've got a 1-year chart here. You can see that it's doing very well. Oh, I wanted to show you how you would buy that. Let's say you're interested and you want to have some gold and silver. You don't want to put it under your mattress. You don't want to put it in a safety deposit box at banks because you realize that the rules are written such that the bank can confiscate that if they want to. It is possible. So you want to put it in a safe place, or you could put it in a company like Kientz that offers you yields to hold it. And you could simply trade it if you want to, or just sit there and hold it or spend it. You can do a lot of different things. How do you want to buy it? I typically recommend a limit order. What is a limit order? A limit order that says, I want to buy gold at this price, but that's the top price. If you just put in a market order, you're going to be filled on your order. Whatever the market says you can have. There are no limits. You didn't put a limit. So if the market moves up really fast or goes down really fast, that could either work to your advantage or really work to your disadvantage. But if you put a limit on it, you're saying, I want to buy gold at this price or sell gold at this price. And I don't, and if I want to sell it, I don't want to sell it if it goes below that price. I don't want to buy it if it goes above a certain price. That puts a limit on it. So you may not, be able to buy a certain price, but it could save you from having a bad trade. So what you do is you simply go to buy on the exchange when you log into Kientz, and you put in your limit price. I'm going to do the current ask. I just click on this ask button. It fills in what the current price is. That means I don't want to buy it for over what the current price is. That's my limit. You can say how many I have. Now I don't have money in KEU currently in this account or in cash in this account to buy it. So it's going to tell us that, but I'm just going to say 1 KEU, and total with the little transaction cost there is $107. Or if you wanted to, you could say, well, I want to spend 25% of my available assets, 50 or 75, to buy it. I'm simply going to say I want to buy 1. And then, as you can see, I don't have the money in there to buy it. But if I did, I'd simply hit that button at the bottom, and it would execute the trade. And if the price went above 106.84, wouldn't execute it. It's a limit order, as opposed to a market order in which you're just saying, buy at any price. I want to buy it whatever the market says, and I simply say how much, no limits. To protect yourself and make sure you get the price that you want when buying or selling gold, simply put in a limit order on Kientz. It will execute that trade. And there you go. You've got your gold and silver safely stored in one of their world-class depositories. And you have gotten the best price on the market for it, which I highly encourage. Thank you guys for tuning into the Free Report. That's going to do it for me this week. Hope you guys enjoyed it. Remember, the bond markets are blowing up. Where is the world already going to? Gold and silver, the big players. I showed you that. Where should you go? Well, I'm not your financial advisor. Certainly you should contact them. But what I'm doing is buying gold and silver. And I like to use Kientz to do that as well, because they store it safely, very low transaction costs. I don't have to take delivery, and I can simply buy it and sell it anytime I want. It's safely protected in the warehouse. And if I want, I can go back later and sell that for cash or redeem that gold as well, as long as it meets the rules for redemptions. And that is a great way to do it. All right, this has been our video for today, ladies and gentlemen. We'll come back and do another one and talk more about the markets, gold, silver, and macroeconomics as we continue to educate you. Thank you for tuning into the Freedom Report. Until next time, this has been your host, Rob Kientz. Good night and God bless.